We're here at Bogle Heads 9 with our mentor, Jack Bogle. Jack, thanks for speaking with us.
Always my treat. Thank you.
One of the striking things that I heard you say at one of my first meetings was that you could teach just about everything about investing in just a few minutes. If I were to put you in front of every single person in the country for those few minutes, what would you say to them?
Well, I'd say first, invest you must. If you don't put money away, you'll end up with nothing. Pretty clear. How to invest, don't make it any more complicated than it is. Own the stock market and own the bond market. And you can own the stock market through an all-market index fund. You can own the bond market through an all-bond market index fund. And that's the most sensible way to invest. And you have to figure out kind of for yourself. If you're young, you want to be very heavily towards stocks. If you're old and you've got more wealth, less appetite for risk, need income more, you want to tilt heavily to bonds. It's a lifetime asset allocation struggle. And just make sure the funds you buy are low cost. Don't pay sales loads. Watch out for funds that have high turnovers. Index funds do not. Make sure you have very, very low cost operating costs and zero management cost, which you do in an index fund. And then be careful of tax efficiency, because trading is very expensive. You pay taxes, and that devastates long-term investment returns. So it's the bond market and the stock market, and get the costs out of the equation. And I guess my final piece of advice would be, don't peak. Just put your money away month after month after month after month, and don't look. And if you start when you're 20 and retire when you're 80, which I'm thinking about doing but haven't decided to do it yet, and you see what that account is worth in 60 years, you aren't going to believe it. Throw everything else out along the way.
That sounds like fantastic advice. So when you're tempted to peak, or even worse, when you're tempted to do something in response to everything else that's going on, what should we do? How do we avoid that?
Well, there's this great sort of American ethic that we can always win, and the great statement is, don't just stand there, do something. And my advice is, don't do something, just stand there. Because we get most excited and most depressed and most likely to sell when the market's at a low, and we get most elated and most optimistic when the market's at a high. When the market's at a low, you're tempted therefore to sell. When the market's at a high, you're tempted to buy. So don't try and time the market. I've often said that I don't know how to time the market. I don't know anybody who has ever been able to time the market successfully. And I don't even know anybody who knows anybody that's timed the market successfully. That's a lot of people.
One last thing. Your career spans 60 years, and you've done a lot of amazing things and achieved quite a bit in that time. 50, 60 years from now, what would you want people to remember about you, or remember about your accomplishments or achievements?
I haven't spent a lot of time thinking about that. But it would be something like, he was an ordinary person who did his best. Not that.
So 39 years ago, almost to the day, a little bit longer than 39 years ago, you started the Vanguard Group. Jack Bogle, one of our heroes at the Motley Fool, for so many different reasons, which will come out hopefully in our conversation. I mean, it starts with simplicity and clarity, integrity, and a solution that is transparent in a financial industry that works so hard against those qualities, it seems, many times it seems. So what was life like for you in 1974? Can you paint a little bit of the picture of what Vanguard was then compared to what it is today?
Well, sure, and this will not be very surprising to anybody that's ever started what we call in the modern age, didn't use the term then, a disruptive technology. And we were shrinking. We had about, when we finally broke up the Wellington Management Company into certain operating units, and Vanguard took over the administration, we were going downhill. One of the directors said, "Bogle, do you realize we're hemorrhaging?" Realized that we had money pouring out, more money going out than coming in for 83 months. So you've got to be kind of blind, you've got to be kind of stupid, and you've got to think that it's great news when a month's cash flow goes from $20 million out to $19 million out. Everybody condemned the index fund. Ned Johnson said, our shareholders would never want a fund with average performance.
Mere average.
And by the way, that was the year 1976 probably, when all the Fidelity funds had fallen out of bed and they weren't getting anything like average performance, by the way, just for the record. And for whatever that, I don't know, philosophical bent was on his part, nice enough to say, they now have a $150 billion index fund business. So you've seen this huge swing. Help stamp out index funds. Bam, 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 that big Wall Street poster. Everything was negative. The Wellington Fund had been about destroyed by our partners from Boston, from an investment standpoint. Fund dropped. That was our kind of the flagship of the Vanguard fleet. Dropped from $2.1 billion to $400 million. The performance was the worst in the industry for any balanced fund. There wasn't a lot of good news around. All the funds that were part of the merger went out of business. iVest fund finally, funds that people had never heard of. The dustbin of history, we say. Fund called Technivest, using technical market analysis. Yes, Wellington brought out such a fund. And a fund for trustees called Trustees Equity Fund, the first one. And it crumpled like tissue paper in a fire, to pick a metaphor. So everything was bad. You had to know you were right in the long run. You had to know that gross return in the financial markets minus cost equals net return. Pretty smart here. That's the underlying principle. And you also, and I didn't really phrase it this way in those days, Tom, but when you think about it, we're all indexers. Every investor in America is an indexer because 25, 30%, let's call it 25% is indexed, but the other 75% own the index, but one at a time. I mean, that's the total market. And if you have the total stock market fund, you either own it as a unity or you own little chunks of it and somebody else owns the rest. So will the unity, let's call it the unity business of the index fund, do better than the trading business with all these other people that own the index trading with one another and try and outpace them, which of course can't be true. And they pay their little helpers, and therefore they have to lose. So it's all so clear that it is a disruptive technology and that it works. But anytime you try and introduce a new idea, first it'll never work. Then it'll work, but only for a short time. Then the guy's really lucky, and finally, he's right.
Do you think during the guy's really lucky phase, or is there a phase in there where it is the guy's a threat and we're going to say whatever we can to confuse people about the solution that he's putting in the market?
Well, they can try that, but it's too late for that. It's too late. In the last 5 years, roughly, $400 billion has gone out of actively managed funds, and $600 billion has gone into index funds. It's a $1 trillion swing. Just for the equity part of the business is probably around, I don't know, 6 or 7 trillion. It's a huge swing in 5 little years. So the market is responding. Even the people that don't like it at all are doing it because the client insists on it. And part of the insistence has gone in the wrong direction. And that is, we have the ETF, which is a way of trading the index fund all day long in real time. What kind of a nut would do that?
Well, there are a lot of nuts out there, though, right? I mean, even though there's been a tremendous growth in index fund assets, simultaneously there's been a complete diminishment of long-term investment as a principle that is both adhered to by individuals, by professionals, covered in the financial media that way. The average holding period for a stock or a fund, or the holdings within an actively managed fund, turnover ratio is north of 100%. Used to be.
It's actually much higher than that when you look at the cost of it, because that's the lesser of portfolio sales and purchases that you count as the amount of turnover and then divided into the assets of the fund. And the fact is, whether it's more or less or even the same, you've got those two sets of transactions. You take money out of a stock, that costs money, and you put money back into another stock, and that costs money. So the costs are very, very high. The unit costs, in fairness, cost for trading a share used to maybe 30 cents, 25 cents in the old days, and now they're probably less than a penny. But if you're trading, I don't know,
Is there
500
anything?
times-
Is there
500
anything
times
good
as
about
much.
anything good about trading, in your opinion?
Well, yeah, I think the market needs a certain amount of liquidity, and I accept that. But how much liquidity do we need? Do we really need the market to turn over 250% a year? Well, I grew up in this business. There wasn't a liquidity problem, and the turnover was 25% a year. So I've been known to say, you'll like this expression, taking on or copying Samuel Johnson on what he said about patriotism. Liquidity is the last refuge of the scoundrel.
And the scoundrel is transacting that frequently because what's motivating them? It's human nature and they're blind to what they're doing, or there's a built-in conflict of interest that's causing a professional to transact either in their retail client accounts or for reasons inside their fund.
Well, first, there's a lot of ego out there. Even someone you know has a pretty big ego, but he doesn't use it on saying I'm smarter than other investors. But we all think we're smarter than the other guy. We all think we're better drivers. Sometimes I think we all think we're better lovers. I don't know about that. But, we're all average. We know that. And have to be and will be. And no Lake Wobegon here in the investment business. And then we have this massive marketing machine of paid salesmen who can always beat the index. Because if you've got a universe of 500 funds and someone says, the index, I want the index because it does better, your problem is you're looking at the average fund. I will give you a fund that's above average. And it's always easy to do, very easy to do. For some period, for some fund, it's the easiest thing in the world to do. So the sales machine, and they have conviction they're doing the right thing, but they've got to know deep down they're not doing the right thing. And
Now, there have to be some that you believe are doing the right thing on the active management side. There have to be some investors that you've encountered over time that you think it's admirable what they're doing, and actually the results, so insofar as we can draw a conclusion off of a single sample of one person's lifetime, appear to be above average, sustainably.
Well, I'm not sure above average is quite the standard, and that's a really tough standard to meet. But you can do a perfectly good job, and the managers I like, and I don't hesitate to say who they are. You can look at Dodge and Cox, and you can look at what the hell's the name of that place, Mike, down there? Longleaf.
Yeah, love that.
You can look at clip that out.
Oh,
you can look
we're gonna push the volume up on that.
and you can look at Longleaf, and there are probably a number of other small firms.
Yeah.
What is their what's so good about them? They are in the business of investment management and not in the business of marketing. This has become a great big marketing business, and they stick to their guns and they manage money. They slip, they stumble, they err, they make mistakes. This is a business for all that. But in the long run, I would bet on someone whose business is trying to be a professional investor, not a trader, someone whose business is trying to serve you rather than serve the marketplace. So there aren't a lot of them, and I don't want to put a curse on them because they'll get too big and they won't be able to do it anymore. And that's a little one of the great secrets of this business, and that is if you're really good for a long enough time, you draw an awful lot of money, and then you can't be good anymore.
Too big to succeed.
Too big to succeed, or as Warren Buffett says, a fat wallet is the enemy of superior returns. And of course it is. So if you can get someone that can give an index a good run for its money, I wouldn't say you're going to do a lot better. I don't think they would say you're going to do a lot better. But it's a good alternative because you don't have all this infinite number of choices. I think Longleaf probably runs, let me say 4 or 5 funds. Dodge and Cox runs 5, I think. And yet the rest of us Fidelity runs 260 funds. Vanguard runs, I think it's around 170. I'm not sure anybody really knows. And that's tough on a whole lot of levels.
Can you describe fundamentally how an index fund works for somebody who's watching and owns a Vanguard index fund? How does the process work behind the scenes? Is it 5 robots, three monkeys, and a bunch of data, or are there human choices that are going into the index?
Well, first you can match the index in a very casual way. Just, I mean, if I don't know, Microsoft is 2% of the index, you just put 2% of the portfolio in Microsoft. And then the same thing is true of every other fund. Not very complicated. And if you don't do it with great professional skill, all kinds of quantitative support, you will do a perfectly good job, but not a perfect tracking job. In the long run, you'll match the index, but you might beat the index by 50 basis points, 0.5% in a year, and lose to it by 0.5% in another year. The tolerance is very small. But people like to see, or investors like to see, a tight tracking. And so you do all these quantitative things. They're definitely call for quantitative mathematical skills, particularly when there are additions to the index or subtractions. That happens more in the Standard & Poor's 500 than in the total stock market. But it's a very simple thing conceptually, but to do it with something that approaches perfection is just what you say, a lot of quantitative people hidden behind the walls.
If we take the concept of too big to succeed and apply it to capitalization weighted index fund, isn't that a bad idea? Wouldn't it be better to set the index fund up on a different set of criteria rather than weighting it by capitalization? Aren't we buying the largest companies and the most successful companies which have the smallest future market opportunity and underweighting the small, potentially upstart, disruptive future vanguards?
Well, you're saying that cap weighting indexes give you a flawed index in effect. And I guess my first comment would be, since such an index beats the heck out of money managers, what kind of trouble would we be in if there were a perfect index? So, and then I'd also say, much more importantly than that, and that is, if the idea of indexing, as Paul Samuelson described it when he wrote the foreword to my first book, was you will get better returns than your neighbors and sleep better than your neighbors. And your neighbors own the capitalization weighted index. Now, will a value weighted index do better? Will a dividend weighted index do better? Probably it will do better some of the time. I do not believe it will do better in the long run. That remains to be seen. But when you think about it, if, let's say, fundamental indexing, whatever that means exactly, but a weighting by some company, corporation data rather than by market price, still owns essentially all the stocks that the S&P 500 owns, which is somewhat different weights. Not huge, but somewhat different weights. So they may do better, they may do worse. But if they continue to do better, well, what will happen? Everybody will take their money out of the market-weighted index and put it into the value-weighted index, and then the opportunity will vanish. That's the way the markets work. I don't think it's going to work, and I don't think that it's worthwhile to add that risk. I know what I can get. I can do better than my neighbors. I can own the whole market. That's a little beyond the S&P, but it's a perfectly good way of looking at it. Do better than my neighbors, and should I give that, let's call it certainty of relative return, up for the uncertainty of whether one of these schemes that's out there, equal weighting, value weighting, dividend weighting, fundamental weighting, all kinds of weighting.
I kind of feel like equal weighting would be a smart, but I guess time will tell whether that plays out.
It works sometimes. I mean, we have data going back forever, but don't let the past data impress you. When people start actually doing these things, you know this from your own experience, that what comes out of the lab is seldom reflected in the real world.
How many mutual funds of an index variety, let's say somebody's indexing entirely, how many funds should they own as an individual? What's too many and what's too few?
Well, you can certainly do it with one. And that would be something like the Vanguard Balanced Index Fund. It's 60% total stock market, 40% total bond market, both U.S. And that's fine.
So a person out there could simplify their lives, make sure they're paying off all their high interest debt, it's gone. They're saving a portion of their salary each year, and they're putting it all in the Vanguard Balanced Index Fund.
Right.
And that three-step approach is going to improve the outcomes for the majority of investors out there, number one, and you think it's completely reasonable to put it all in a single fund?
Well, there are obviously a lot of nuances here, and one of them is if you're younger, I would think you'd want to be 80 or 85% equities.
Okay, yeah.
And if you're older, I would think, although interest rates are so terrible today, you have to rethink all these things as the markets change. But older, maybe 25% equities and 75% bonds, something like that. And this kind of an age-based, your bond position should equal your age. But that's a rule of thumb. And interestingly enough, it shows a gap in the kind of the way these target date funds that are very popular today are structured, because they ignore the fact that 85% of their shareholders have Social Security. And if Social Security, when you begin it, has a capitalized value of maybe the stream of future payments you will get is capitalized at around, let me say $350,000. If you have $350,000 totally invested in an equity index fund, you're 50-50. You don't look at it that way, and your behavior may get you in trouble that way because I got too much in stocks. But what people should be doing, honestly, Tom, is stop looking at the silly stock market every day and look at the cash flow they get. And in a Social Security, those payments are going to continue. They're going to grow with the cost of living. I'm certain, as certain as I can be, the Social Security will be repaired simply because it has to be. And I don't think its future is in doubt. If we can just wake up a few of those people down in the nation's capital. And for stocks, you probably want to look at more of a dividend bias. You could buy a high yield dividend index instead of the total stock market index if capital flows. And that dividend, if you look at the stream of dividends, it makes the stock market look violently volatile. The dividend stream goes up, up, up. And the fact of the matter is there have only been 2 significant dividend cuts since 1925. One was in 29-32, and the other was a few years ago, 2007, 2009, when all the financial companies pretty much eliminated their dividends. We've already recovered from that. That's over. We're on the S&P, Standard & Poor's Index, is paying more dividend now than it was before the drop. So all of these things are clear in the past, and in a lot of ways that doesn't matter. But if you assume that American business grows, that America grows, that the dividend stream will keep going up. And as people ask all the time, corporations sitting on huge amounts of cash, so dividends should not be jeopardized, absent some real problem in the world, in the economy. And people should be aware of that. You know, nothing is a lead pipe cinch in this world. But you have, actually, it's sort of amusing. You have a couple of big risks out there. You know about the economy, you know about it, international kind of hanging on by its own. You know about the dollar, you know about the Federal Reserve buying all those securities and trying to bid the prices up of assets, not a particularly wise move. And you have to assess those risks and try and make some kind of a judgment, however difficult, about how they come out. But you also have to realize a couple of things. Well, that's the second set of risks is really the incomprehensible risks, like nuclear warfare or a meteorite hits the U.S. Well,
or robots begin to control our society.
It won't matter whether you have stocks or bonds or anything else.
Club, you'll need a club.
Yeah, just a club. So there are all kinds of big and small risks. Yeah. But as I've often said, we're sitting here knowing where the world is going into the hell in a handbasket. But people have been worried about that since the beginning.
The knowns are not the known fears are not the ones to really fear. And so are you? And by the way, Jack, I truly can't believe that you're 84 years old. Are you 84% in bonds?
No.
Okay.
No.
Yeah. So you're violating your advice.
Well, yeah,
I'm kidding.
It's by rule of thumb.
Yeah.
And of course, at 84, your Social Security doesn't have a capitalized value of $350,000 either. I like the next check to come in. My wife doesn't think we should take the checks, but we postponed them until we were 70, and we really got I can live on what I get from Social Security because we live in a fairly modest way, modest by the standards of, very modest compared by the standards of what you see in the financial world and corporate world, but pretty nice compared to the typical American worker. And so you start with a rule of thumb.
And then you work back
and then you got to think about, and I don't know, I haven't figured out, Tom, how to do it, but When I first introduced this rule, I can remember back in 1999 at Morningstar. I told them that I was reducing my equity position from about 75% of my holdings to, I think, 30% of my holdings, because the stock market was selling at 35 times earnings, and the bond market was yielding 7%. And I looked at the transcript a while back, and I said, you know, honestly, when I look at the math, I don't see why I would hold any stocks at all, because at 30 times, 35 times earnings, stocks were not going to give you a 7% return in the first decade of the 20th century.
But now you look at the numbers and you're not really sure what to do about them.
Well, now, you know, my own position is that stocks are more or less fairly valued, probably a little on the high side, but, you know, more like, depending on whose numbers you're using, 15 to 17 times earnings, maybe 18 times earnings. It's a long way from 35, half. And bonds are not yielding 7, they're yielding, depending on what you want to look at, 3%, 2.5%, 3.5%, depending on corporate government mix, maturities, and things of that nature. So you have to think a little bit differently. But I have not done anything about that. I don't change my portfolio.
Mm-hmm. I want to talk a little bit about financial advice and how that side of the business works, because Vanguard is at least perceived to be exclusively a mutual fund company. So a lot of individuals are trying to figure out how to put a portfolio together. It's helpful to hear the number of funds that you would put into an account for an individual, and it's relatively small and should be manageable and a decision that an individual can make on their own. But yet many people come to their finances and say, you know, please, Jack, just do it for me. Like, I'll literally give you the authority to make all transactions in my account. I don't want to know anything about it, which of course sets up a lot of people to be taken advantage of by financial advisors. So what do you think of the financial advice side of the decision-making process for an individual?
First, let me just take this, maybe you think it's kind of a nuance, but I got a letter from a shareholder the other day saying, you keep telling me you only need 3 or 4 funds, why do you have 170? And I took the simple example for him. We have like 60 bond funds, 60. Why is that? Well, we invented or created or developed a system of, you tell us the maturity, how much risk and how much income you want. So you get short, medium, and long, and also a couple of variations around that. And then in the municipal area, you only have the funds themselves, but you do in different states. And then we get some bond index funds, and we probably have 60 bond funds out there. So an investor either has to know and do the math. Should he be in municipal bonds or in taxable bonds? Very important decision. And right now, municipal bonds look very attractive simply on the numbers, those kind of numbers. And then you have to decide how you want to balance risk and return. Obviously, the higher yields, no matter how depressed they are in long bonds, but the greatest risk is there. And the lowest yield is in short, but the greatest principal stability is there. So those are decisions investors really have to think a little bit about. It's not just, you can buy the bond index to be sure, and that turns out to be an intermediate term bond fund, in fact. And that's perfectly satisfactory. But we kind of nuanced ourselves to death a little bit, and you should, in terms of taxable and tax exempt, deal with that issue. And I'd say, to simplify, most investors should be in tax exempt, just because they yield significantly more than treasuries, even before you take account the tax exemption. So I think they're attractive, and maybe you want some treasuries there as your bulwark, and you can buy a treasury bond fund. And it gets to be a little nuanced. I think the interesting question is, if you want financial advice, how much should you pay for it? Let me give you an interesting little piece of math. I look at the stock market investment return as a 2% dividend yield at the present time, low but not nearly as low as the 1% we want, and a 5% earnings growth. That's a 7% investment return, and over the next 10 years, I don't think it's going to go up because of higher PEs. We're down because of lower PEs, not down much anyway, and so there won't be any speculative return by my reckoning. So we've got 7%. That's nominal. And so we go to real. And if we're lucky enough to get 2% inflation, that's 5. A typical fund manager is taking 2. That's 3. And if you give a 1% to an investment advisor, that's a third of 3, and you're down to 2. And if you're a fund picker, you lose around 2% by jumping on the latest bandwagon. And 2% minus 2 is a number that I won't recalculate for your audience.
Well, it's a reminder of Warren Buffett saying that the financial services industry is an extractive.
Sure. The economists call it rent-seeking industry. Of course it is. It has to be. And it has to shrink. It has to get its costs down. The trading volume has to come down. And a lot of mutual funds are going to have to fight. They're going to be cash cows. The big mutual fund companies are fantabulously profitable. And they can't change what they're doing and do what we do because they would not be profitable to their owners. Either financial conglomerates or all those partners at Capital Group or the Johnson family up at Fidelity. I mean, their wealth is like 20 billion or something, putting the family all together. They've done great in this business. Whether their shareholders have done great is the question that interests me. That's where we should be focused. And the financial conglomerates, the same thing. They basically tried to destroy this industry. They own 40 of the 50 largest fund groups are publicly held, and mostly 30 of them by financial conglomerates. And think about buying a fund that's run by a financial conglomerate. Why did they buy their way into this industry?
And why are there more funds?
The Golconda. They wanted to jump on the wealth bandwagon of managing money. And they will accomplish that whether by hook or by crook. If their return capital threshold is 15% and they pay $1 billion for a mutual fund company, they're going to have to take out $150 million a year. And it's easy. All kinds of things you can do to make it.
You're a fan of capitalism. So if we look in the marketplace in finance and compare 2 actors out on the stage, one of them is a fee-only fiduciary financial planner with a basic flat fee dollar amount that sits down and builds a Vanguard-based index low-cost portfolio, acting as a fiduciary. The other is a financial advisor or broker. I'm reminded of 3 that came to a book signing in San Diego years ago of ours and said, you know, you talk about the Vanguard Index Fund. It's really funny you say that. We now manage money. We've left the firm that we were at. In their case, they were at Merrill. And they said, we couldn't sell the index fund to our clients because we couldn't make any money on it. But we all owned it ourselves. So it's almost the complete reversal of the fiduciary. It's like I will be fiduciary for myself, and then fiduciary with my relationship with you is, hey, if you buy it, if you're willing to buy what I'm selling, then I haven't done anything that I should feel badly about. So the reality, though, in the marketplace is that the first actor, the fee-only financial fiduciary, is living a relatively lean, existence in terms of the financial makeup. And the VP of the big investment firm has a country house, is making $1 million a year selling load funds and a whole bunch of booby traps in the portfolio to keep you locked into different products. So how do you observe, and what conclusions do you draw about capitalism given that?
Well, capitalism is very funny, has a very funny manifestation when you get to the fiduciary duty of managing other people's money. Most systems, particularly when you begin with a new idea, for example, if you want to get it sold, you pay the salesman a lot of money, you advertise a lot, and you deliver 70 cents on the dollar or something like that. And in the investment business, is really a business of sort of mathematical candor. You can't hide. If you're selling a Mercedes-Benz, the salesman is selling it, he's going to say, look at the value you're going to get. Your neighbors are going to be envious, blah, 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 whatever it is. And you'll like the diesel fuel, or the door slams nicely, or it's got a great sound system, or with air conditioning, I don't know what. But in the financial business, value is one thing, dollars. It can be measured, unlike all these esoteric things that characterize capitalism. And once you get to measuring value, the problem becomes a very simple mathematical problem. Now, how do you get people to focus on that is a good question. How do you get them to focus on the role of cost in that is a good question. How do you get them to think about the long term? Because in 2 or 3 or 4 years, the difference in cost, let's face it, just doesn't matter. but over your investment lifetime, getting the market return in an index fund or almost the full market return compared to paying 2%, which is roughly the right number for a managed fund, means that you get, in the latter case, about 30 cents in the dollar that you get in the end. 30 cents. But you got to look at 40 or 50 years. But these young people today, say they're 25, 50 years is 75. That's too short. They'll live to 95. They should be looking at 70 years. And these numbers just get further and further apart. So, you do need, a lot of people need help. There's no question about that. But I think we have to rethink how we pay for that help. Maybe that 1% is much too high. All at 1%, if you have a client with $25,000, 1% probably isn't nearly enough. So I think eventually you'll have a fee-for-service kind of thing, like typical professional service, lawyers, accountants, and so on. Neither profession of which I'm particularly smitten with, have gone that way. That's the way they conduct their business. And it's more of a professional approach than a business approach. But don't try and get me to tell you there are easy answers to this. You need help out there. People need their hands held. There's no question about that. And paying a little bit for it is probably better than doing nothing. Just trying to do it yourself. And the worst thing of all is not investing at all. That is the one guarantee we have in the financial business. Well, there are actually two. One is if you buy the index fund, you'll get the market return. And guarantee two is if you don't invest, you will get nothing.
One of our members, Neil, wants to know what you think of, well, let's take the family that I was raised in, which taught us from a relatively early age to buy stocks directly. I'll make the argument on behalf of it. And then Neil wants to know what you think of that argument, where you see strengths and weaknesses to it, and feel free to knock it down entirely. You'll just be knocking my whole life to the ground if you do.
Would I really be doing that?
No. So we were raised in a family and taught to invest in stocks. It was a low-cost alternative, a one-time payment, and we were taught to, I guess one of the primary pieces of advice I give to any investor who's buying stocks is double your holding period right now. And if you want to do it right after you've done that, it's great, double it again, because just as with a great fund, a great business should be held over at least 5 years to really see the value of that organization play out in the marketplace. So we were taught to buy stocks, the low-cost, one-time transaction, find the great businesses with a great leader who's Howard Schultz has been in Starbucks, John Mackey at Whole Foods. These businesses have compounded incredible returns since they came public 20 years ago. And, hitch your wagon to the stars of these really great, often consumer-facing businesses that we can follow. Have to do a lot of numerical work and valuation, et cetera, but that's how we've been building our portfolios in our family. And so our perspective is, and Neil wants to know, what do you when is it appropriate in your opinion for an individual to buy stocks? Is there a level of expertise or interest, an amount of time you should have, or capital, or it should be a side frivolity in a base portfolio of index funds, et cetera?
That last sentence captures it best, and that is, you should have a serious money account. I might even call it a boring money account, where you put money in the stock market index fund and balance it out a little bit with some bonds, depending on age and so on. And don't look at it. Don't look at it for 50 years. Don't peek. But when you retire, open the envelope. Be sure a doctor is nearby to revive you. You'll go into a dead faint. You can't believe there's that much money in the world. And that's where we fool ourselves. So that's a serious money, boring money account. We have a gambling culture here in this country. Maybe every country does. You see it in its finest manifestation, or maybe I should say worst manifestation, in the lottery, state lottery. Las Vegas contributes its share. The races contribute their share, the track, and all these are just gambling, where a whole lot of people bet their money, and a whole lot of people take their money out, and the croupier wins. The house
3
wins.
to 20% of
Yeah,
whatever has
whatever
been
it
bet.
is.
You put $1 in, you'll lose.
So I'd say have a funny if you have the gambling instinct, and most people do. At least start off. I'd say start off with an index fund, period, and for 5 years don't do anything else, and then look around and see what's happened in the 5 years. See how it felt when the market dropped 50%. See how it felt when it came back. And those 5-year periods are going to be very different for one investor and another, but because they're all over time. But Then, when you get there, 5% in the funny money account.
What would have happened to Warren Buffett if he had done that? He would have, a tremendous amount of value would not have been created by his understanding and ability to evaluate a business for investment.
Well, name two.
Well, Longleaf, you mentioned Longleaf, Dodge and
Well,
Cox.
but they don't have the sensational returns. They may probably have something above par returns, but maybe a little bit below par from time to time. So, and then don't forget in Warren's case, he wasn't running a mutual fund. The mutual fund is a badly structured business for investment management. We say, and this is the way it has to be really, you can take your money out whenever you want, and you got to be ready to put it in whenever you want. And so you ride on these waves of optimism and good performance, and the money comes in up here, and then reversion to the mean, which is a big part of my recent book, a big part of the final chapter of my recent book called Clash of the Cultures, and it's happened everywhere. It's happened in Magellan Fund. It's happened in T. Rowe Price Growth Fund. It's happened in our old IVEST fund. It's happened in Fidelity Trend Fund, that Ed Johnson happened to have run. It happened in CGM, all the hot funds. They were all in there for the last 25 years, and they all look like this. You put them over each other, looks like the Himalaya Mountains. The reversion to the mean is a constant pattern.
For the individual, I'm just going to poke around here a little bit just to get your full philosophy. For the individual, it's unlikely that you're going to hit the mountaintop of the Himalayas with your portfolio. So you may not have to ever see the other side of the mountaintop unless you have so successfully invested that your personal account is moving up in a billion-dollar
Let's say you
asset.
bought Magellan before it was for sale, which is where that record begins, by the way. There's a lot of phoniness in this business. But you're going to enjoy the mountain. And you're not going to know it's a mountain. But when that mountain gets up there, you think, my God, I found the Holy Grail.
Now I'm really going to go all in.
And now I'm going to go all out. So there's a lot of behavioral kind of stuff, not to use too fancy a word, in the mutual fund industry. Interestingly enough, Tom, there is no behavioralism in the field of stocks generally. How could that be? That is because I'm a dumb behavior. The guy that buys my stock from me is a smart behavior. We offset each other. I mean, it's not as if I can make a behavioral mistake without somebody else making a successful behavior thing, the other side of the trade. So, I think we take a lot for granted. We listen to all these theories, and big, old, boring indexing is the answer.
Have you ever bought individual stocks and/or actively traded funds? And if so, what do you look for in those investments?
Well, when I came into the business, I had friends in the brokerage business. I bought this and that and the other thing. And then I had a broker. And he would tell me this was good, get out of that and get into that. And it wasn't that they did badly, which was, of course, what they did. But it was, I just couldn't stand to have my phone ring when I was trying to do my work. So I haven't owned individual stocks since, let me say 1960, I don't know exactly, a long, long time. I've never bought anybody else's mutual fund, although I did buy a nice backup investment for my son John Bogle's fund, Bogle Small Cap Growth. And so I did that, and it's done actually rather nicely, of course. He's very smart. And so that's about it.
Even the most successful actively traded funds at Vanguard have a period of 3 years, sometimes even 5 years, where they underperform. But net they've outperformed. If in the case of outperforming actively managed funds, that let's just say they have a few qualities that we probably both love: very low turnover, tenured leadership, a very fundamental businessly analytical approach. But even in those cases where the fund is very well run, or even Warren Buffett and Charlie Munger are going to have a period of a couple of years potentially where they lose to the market. What's the appropriate amount of time to hold something before saying this team doesn't really know what they're doing?
Well, let me start off with I should explain Vanguard's philosophy as I implemented it, not as they necessarily do today. And that is very early after we closed Windsor Fund back in 1985. It was getting too big, and we started Windsor 2. And everybody said it would never do nearly as well as Windsor. And of course it's done better a little. They track each other very closely, so I don't want to make an issue about that. And then we had U.S. Growth, and that was run by Wellington. We decided we needed a new manager, and I wasn't so sure about them. So I did what set the standards for everything everything I did since then, and that is bring in another manager, and then another manager, and then another. So we have a lot of equity funds that have 5 managers. It's not that it's easy to pick 5 managers, but if you're comparing yourself with the universe of, let me say, large cap value funds, and there are 50 funds in that universe, 5 is going to have the same return. It's kind of a law of large numbers thing. So most of our equity funds have 5 to 7 managers. So there's not much premium on manager selection. You hope they will do well. We're happy to have a good year, be having a good year this year. But we'll have a bad one because that's the nature of the business. What you don't want is something that is so departs so far from the market, particularly on the upside. You don't like it on the downside, but on the upside, it draws money in. It brings in these investors who are looking for the next big thing, the next hot thing. So, and we win by about 1.5 points a year on average, not because we pick better managers, because we have very low operating costs, our expense ratio. We negotiate the fees way down with the advisors, the fee rates, because the advisors are not starving to death in terms of the dollar fees. And then we've looked, as you said, for long-term managers with lower turnover, and then we have no loads. So if you look at all those numbers, if we're good enough to be average, or lucky enough to be average, we win by about 1.5 points a year, which is 20% over 10 years. And I always thought that was quite good enough.
Awesome. Is there ever, just a few more questions, is there ever a situation that you can imagine where an individual should own a load fund? They've sat down with a financial advisor, and now they're watched this video and they're looking through their portfolios, we're talking, and they see a number of funds that their advisor has put them in that carry a load. Is there ever a situation they should be happy about that?
I'd say unequivocally not. You can look back. The advisor's going to say you a load fund. He says this no load stuff is bunk. Here's the no load index, and this fund, even counting the 5% commission, which is roughly where they are today, although a lot of that has changed to advisory fees, and even with that 5% commission, we did 50% better. Well, hindsight is always 20/20. If they can't find a fund that beat the index, I don't know, they can't be very acute. They can't be paying much attention. It's the easiest thing in the world to do. But don't believe it. The past is not prologue. And actually, if you look at the numbers carefully enough and long enough and thoughtfully enough, you'll see the past performance of a fund is anti-prologue. The better it is in the past, the more the regression to the mean is going to be, the greater that's going to be in the future.
Do you believe that we will have a unified fiduciary standard or not? Are you optimistic about that? Maybe I think we've explained what it is for some.
Well, let me just say this. The issue is a very narrow issue at the moment, and that is the fiduciary standard for people who are selling funds, investment advisors, fee-only investment advisors, stockbrokers, things like that. It's the firing line level. I think we are making a very big mistake. I've written to the SEC 3 times about this, and that is the biggest problem of the fiduciary side is in the fund manager side. And we need a federal standard of fiduciary duty for fund managers. And if you look at what's going on at the Labor Department, and I've talked to them down there about this, you looked at the fiduciary duty for the corporation and for the evaluator and for this one and that one, but no fiduciary duty for the guy where you really need the fiduciary duty, the fund manager. So we do need fiduciary duty. That would tend to get us out of this morass we're in of short-term trading, of high costs, of speculation versus long-term investment, because it's the antithesis of trading. And it would probably eliminate the conflict of interest that is obvious if your fiduciary has 2 sets of fiduciary duties. One is fiduciary duty to the mutual funds, and the other is fiduciary duty to the shareholders of his publicly held company, or publicly held conglomerate. That fiduciary duty those 2 fiduciary duties are in direct conflict. And so we, of course, quote the Bible. No man can serve 2 masters. And then we add to that what Matthew said right after that, or Matthew quoted the Lord as saying right after that, I suppose. And that is, for he will hate the one and love the other. Now, in this business, who pays the portfolio managers? Who makes all the money? Who has all the public stockholders? The manager gets all the love. And I won't say they hate the shareholders, I wouldn't say that at all, but they love the managers more.
I want to just talk in the end a little bit about the fact that you've been a business leader. We talk about investments, but you started a company and ran that business, and it has $2 trillion in assets today and 14,000 employees. It's a massive, I mean, sure, it's way beyond what you would have dreamed of in 1974,
Correct.
although I'm sure you're optimistic about your chances given the solution you'd created. But how do you evaluate talent, the people that you work with? You know, what were some of the cultural features of Vanguard during your leadership?
Well, one of them is exemplified by a story I tell about the time we got to around 200 employees. And I think, you know, we really ought to have a personnel department. Human resources is called now. Seems like a good idea. And I was, you know, really a dictator. So I looked around and tried to see who was not busy in the office. We were very strapped for being able to spend any money. And there was a secretary in the legal department, a very lovely woman. And I talked to our lawyer. We had one lawyer then, we have 140 now. This is called Progress. I said, you know, could I use her to run a little personnel effort, interview people? And he said, yeah, I think she can do that. So she got into my office. I'd like you to do this. Whatever you want, Mr. Bogle. So we talked a little bit, and she started to go out of the office. And she was about to walk out the door, and she turned around, came back in, and she said, you know, I want to do whatever you want me to do, Mr. Bogle, but I don't know what it is you want me to do. And I said, well, I'm not sure I know either. This is what happens when you're a very small company. And I had a lot of things on my mind, of course. And I said, I don't know what it is that I want you to do, but let's start with this. Hire nice people, and then make sure that they hire nice people. And that's the best I can do on this. You know, most of the jobs at Vanguard, some of the technology jobs require a whole lot of professional skill. Most jobs can be done by intelligent human beings with a little experience and a motivation to do them. So I look at Vanguard as not being some, you know, can we hire the best and the brightest? I mean, that's a big universe, and we probably have our share of them. But you try and get people that you can work with, that can work well with others. They're going to maybe try and not make the same mistakes you did. But it's, you know, the change from a little tiny organization, a little embryonic organization, where there is a captain and the rest of the oarsmen down below on the galley. And that's obviously oversimplified. But our mission is very simple. Our presentation is very simple. When you think of what we can explain to people what they should do in investing, it's right out of the proverbial horn book, the ABCs of the old days. And it works, it's understandable, and is guaranteed to give you your fair share of whatever returns the stock and bond markets are generous enough to give us, or mean enough to take away from us.
There's a Gallup survey that shows that 7 out of 10 people going to work in America today basically say that they're indifferent or even downright negative about the organization they're working for. So in a funny way, in that rowboat scenario where we're all rowing together, in many organizations, more than half of the people don't even really care about what they're doing. So
Well,
obviously you've found people who are passionate about the principles.
Yeah, we have more turnover than I would like, but you know, that happens at kind of these middle grade job levels. Our people are well paid, they've got terrific benefits, the partnership plans, they share in the earnings we generate for shareholders. And I still spend an hour with each Award for Excellence winner, a program I put in there all those years ago. And there are probably about 8 a quarter. So I get to sit down and talk to 8 people a quarter. It may not sound like much in an organization that big. 32 a year, 320 in 10 years, 640 in 20 years. So I feel I have a pretty good, now these are exceptional people, that's why they got the Award for Excellence, so I'm not kidding myself. But we have human conversations, talk about commitment, talk about opportunity, talk about the lack of opportunity, talk about anything they want to talk about. and they're among the most engaging and pleasant moments of my career.
You're in the unique position of having run the company, and now sit as an observer of your creation. Succession is such a big issue for so many. We have a lot of small business owners that are at the Motley Fool and thinking about that. What have you learned, or what do you think about? I mean, you're I find it to be a great thing that you have minor lovers' quarrels with things that are happening at the company that you created, which I think is intellectually stimulating, must be for you and for the organization to think. And so how is that experience for you?
Well, it's difficult. Let me be honest about it. It's difficult. I've had to fall back. The company is not particularly smitten with my directness and outspokenness in my books. So people don't like criticism, generally speaking, but I'm just trying to tell it the way I see it. And I'd say my book, The Clash of the Cultures, almost entirely reads like a great big commercial for Vanguard, but there's some things they don't like in there. Talking about the Wellington Fund fee increase, which I believe was unjustified. Talking about our proxy voting policies. Talking about possibility of having a transaction tax, and a bunch of other things that are similar to that. And so I finally had to develop a response. And when someone says, well, I understand you disagree with Vanguard at that point, I said, absolutely not. I would never disagree with Vanguard. Vanguard disagrees with me.
So,
and it's their right.
Mm-hmm. So you're optimistic about what Vanguard will become over the next 100 years?
Where we are, I mean, you have to be optimistic. I mean, there are risks out there. Will they ever try and demutualize the company? That has happened in a lot of places. I don't think it can happen there, but anything can happen in this world when you get human beings involved. I think it's important, even as we maintain the letter or the implementation of a mutual structure, we have to maintain the spirit of that mutual structure too. And that requires some doing. You've got to keep your mind on the mission, that your mission is to serve day after day after day. It's very difficult to see anything that can get in the way of that, except some massive thing like a huge stock market collapse. It would not be good for us. And every once in a while we depart some of these new funds. I have a little question mark about, you must be betting they're better than an index fund. I wouldn't even look. I just say, I bet they're not, because nothing can be in the long run. So, I watch. I think people at Vanguard really, I don't want to overdo this, but I think they love me. Mm-hmm. I'm a normal human being, more or less normal anyway, and I'm straightforward. They can identify with that, and even the people that have been there for a very short period of time seem to know who I am.
It's total authenticity, which means sometimes we'll agree, sometimes we won't agree.
Yeah.
It's a member of ours named Vicky was bringing up the importance of skin in the game. You've had skin in the game with the business and have your capital with the Vanguard funds to this day. Mm-hmm. So the mix of those qualities, even though it may lead to some public disagreement, is overall a benefit to both the organization, to you, and to the outcome for the customers of that.
I really don't care who benefits or who doesn't benefit. I have to tell it as I see it. Mm-hmm. And I've been able to do that for a long, long time. It was key to Vanguard going into business. You walk a road that you think is the right road. You walk it as straight as you can. You'd be as honest as you can. I've gotten so, I find confessing my mistakes, which the number in my career, well, I don't even want to get into hundreds, thousands, I don't know how many I've made, infinite maybe numbers of career. It's kind of liberating to say, I really blew that one. And I blew a lot of stuff. But the underlying thesis, if you will, the underlying concept, the underlying idea of owning the market, whatever the market may be, and getting your fair share, has worked and will work. Who else can say that about what's going on in their own company?
Small failures all the way to great success. Yeah. My final question, how are you spending your time now? I mean, an incredible part of your story, which we haven't talked about, but when we've talked to you on the radio, about your human heart. How old is your heart right now?
Well, my heart is I got it when it was 26, and I've had it for almost 18 years. So
You're a year younger than I am.
42, yeah. But I'm starting to feel a little more like 84. And you know, the trail in recent years has been a little difficult, physical trail. I've had some very profoundly serious problems, long hospitalizations. But you know, you go into them optimistically. You get out of my wife as a powerful support, and my kids are wonderful. And you get over the bumps. You're always optimistic. You know, the idea when you go into a hospital again is they put you down on the gurney and you just go, here we go again. And like the whole business of the transplant, my reaction is just the same, Tom. If I thought jumping up and down on the kitchen table and screaming and yelling about the unfairness of life would help my condition, I would do it. But it occurs to me it would make it even worse. So you kind of go along, you speak out with honesty. I mean, I'm not trying to say something to hurt somebody, but I'm not going to agree with something I don't agree with. And you know, I think Vanguard benefits from that immensely. You know, the shareholders, still close to a lot of them, still got a lot of correspondence, still writing a lot. I have an article about to come out in the Journal of Portfolio Management, another article about to come out in the Financial Analyst Journal. I'll forward to a book about Paul Cabot, one of the founders of the industry. I wrote the forward to. And a book about John Maynard Keynes, published by, I think it's Oxford University Press, and which I write the final chapter called Adam Smith and Capitalism. And I did a forward for John Wassick's book on Keynes, John Maynard Keynes as an investor. So I got Keynes, I got Adam Smith, I've got one of the industry's founders, I've got 2 academic articles, and I'm starting to worry that I'm going to run out of things to do.
I don't think that's possible, Jack. And you know, anytime you need any extra work that you'd want to do, just come hang out with fools.
Okay. Well, you've been a good fool, Tom.
Well, it all started with Bogle's Folly, so there is.
We're associated.
But we're bound by name. But
Yeah.
Jack Bogle, thank you so much for taking time, and we could continue this conversation for another hour, but let's let you get on with your day.
And we tire.
Thanks,
Thanks,
Jack.
Tom, very much.
Very happy to be here with Jack Bogle in the headquarters of Bogle Research Center right here in your office in Valley Forge, Pennsylvania. And Jack, it's so great to be able to sit down and spend last time we ran on about an hour and 15 minutes, I think. So I probably won't try to keep you that long, but it's great to see you again and have a chance to talk to you about what's going on with Vanguard and your work.
Well, there's a lot going on. It's a real delight to see you again and to salute you on the work you're doing for the investors out there.
We were saying at lunch, and we'll start out with give you an opportunity to try and manage an ego, which is difficult for all of us as human beings.
Well, not for me, but for everybody else.
Well, I don't think that there is anyone in finance that has either had as big of an impact or as beneficial an impact on the world in history than the work that you've done and the work that Vanguard's done. I mean, if you want numbers, you know the numbers better than anyone, but $3.5 trillion under management, the lowest fees really by far in the category, a completely transparent set of tools and solutions that really teach somebody the principles of how to make money and how to think intelligently about investment. Who else has delivered that to that scale in finance in history?
Well, I mean, I guess I'd say not very many people, but for a very definite reason. And that is most people in this business are trying to make money for themselves rather than for their shareholders. And so they're not focused on giving the shareholder the best break. And if you think about it at all deeply, you realize that the stock market creates nothing. It reflects the returns earned by investors, by Investment America, the corporations of the country, the public corporations. And they have earnings, they pay out dividends, they reinvest the earnings in the business. That's where the value is created. You access that value through investing. So then the question is, corporate America has created this kind of value. What comes down to Investment America? And the answer is exactly what they earn, except that it's then the question is, how is it allocated between Wall Street, essentially the financial system, and Main Street, the people who invest? And the allocation to Wall Street is the objective of this business because everybody is in Wall Street. And what we should be doing is working, and what we have been doing here at Vanguard is putting the investor first and innovating for the investor and not for ourselves, and trying to keep costs as low as we can, which is rock bottom. That's been the idea from the very beginning of Vanguard, because a mutual company doesn't have a private owner out there, and or a public owner, and so we have no one to serve but the shareholder.
Can you think of an analogy in the business world or anywhere in life for the index fund and for the way that Vanguard approaches business? For somebody who's watching this and is very new to finance, is there a food business, or is there a leader, or is there a concept inside or outside of business that you think is a nice analogy for Vanguard and the index fund?
I don't think there really is. And the reason is that capitalism is about creating capital for the capitalist, if that's not too many capitals in one sentence. And not creating, they know they have to provide value. Adam Smith, 1776. The sole role of the producer is to serve the consumer. And in this business, it's dollars and cents. The more one gets, the less the other gets. And in an innovative company, you can create more and more value. You can reduce prices, but you're always making money yourself. That's what capitalism is, the incentive to get rich, if you will. And, I'm doing fine, but I don't own Vanguard. I've never owned a share of Vanguard. But I've been paid a nice salary, and a decent salary, and nice bonus when I was running the place. So I'm not complaining, but I just don't have and never will have the kind of wealth that most people in this business have gotten, because they've charged their investors too much for what they're worth.
Can you really make it very clear what the mutual structure is for Vanguard? Just for somebody who doesn't understand it, is this a not-for-profit? Is it is it a collective? How's it set up?
Yeah, well, first let me contrast it with the typical mutual fund system. And the typical mutual fund system is an entrepreneur of some kind back at the beginning creates a company that forms mutual funds. And that company runs the mutual funds and gets paid for it. And that's the way any company starts. Nothing the matter with that. That is conventional. The difference in the mutual fund industry is when that little baby that needs all that parental care grows up, he doesn't need the care anymore. But some of these funds are 100 years old, almost 100 years old, and they still have that parent watching over them and taking money away. That's too long. The child matures, the child grows up, the child goes off on its own, and Vanguard's contribution is essentially recognizing that and saying, okay, you own the company. The incentives are all gone. You can do that pretty easily.
And again, who is you that owns the company?
You is the shareholders of our mutual funds.
You buy a mutual fund and you are essentially a shareholder, an owner of Vanguard.
Yeah, just to give you each step, here's your fund. It's run by Vanguard, and you own Vanguard. And Vanguard also runs a whole bunch of other funds, and we allocate the cost among those funds. There are now probably 165 of them. So the costs are allocated depending on the fund's own cost, depending on competition, depending on fairness, things like that. So some judgment involved. But we still run this place for, give or take 12 basis points, 12/100%. And the average mutual fund specifically runs straight average, not weighted, about 112. So we save you 1% a year.
90%.
Yeah.
90% plus lower.
Right.
And what does that amount to over long periods of time? Because I think the average person who's maybe sitting down with their accountant sees, well, it's 1.12% or it's 0.12%. That's nothing. That's not going to be a game changer for me in my investment career. I might as well pick this one that I believe in most, even if it's 1 percentage point higher in fees. But what's the consequence of that if those two funds perform the same over 25 or 50 years?
Well, the consequence of that is that the one that's indexed, $1 will produce about $30 at 7%. And the one that's not indexed, and you're paying 2%, the dollar we created about $10 at 5%. That's the 7 minus the 2. So that means that you put up 100% of the capital, you've taken 100% of the risk, and you've gotten 33% of the return. And Tom, if that sounds good to you, I've got a bridge
You
I
got
want
some
to
real
sell you.
estate. And that can not, it's not a big extrapolation to say that can cost an individual who's regularly saving hundreds of thousands of dollars over their lifetime.
Yeah, they would probably pick a number I used, I think, in the Financial Analyst Journal, just taking this through to its conclusion, that a typical retiring investor, putting in a certain amount a month and growing with salary and all, would have maybe $450,000 at the 5% level in his retirement plan, and maybe $650,000 in the indexed plan. That's just the math. It is inarguable. There's no way around it. I call it, after Justice Brandeis, the relentless rules of humble arithmetic.
You cannot avoid the math.
You can't
even
avoid
though
the math.
even though the industry has attempted to at times. But what I'd like to do is to hear you, if you could give the simplest Vanguard-like, index fund-like financial game plan for somebody who's over 50. Now, of course, each of us has all these individual factors of what decisions we've made, but the average person over 50, how simple? What is the simplest 10-minute solution or half-hour solution to getting Vanguard returns?
Well, I'll give you a simple solution, but the one thing we know about the average is, unlike Wobegon, there are a whole lot of people that are here and here and here, and the average is here. So in essence, nobody's average. You're all a little bit above average or a little bit less than average. You may have greater risk tolerance. You may have greater income requirements. You may have greater financial ambitions and are willing to take risks to accomplish them. But in all those cases, the lower the price you pay for owning the stock market and the bond market, the better off you are. Now, I have talked about a rule of thumb, and I want to underscore it's a rule of thumb, a place to begin thinking about having your bond position equal your age. So when you're 20, you'd be 80% bonds. And that's a rule I would not
80%
dream
stocks.
of. 80% stocks. And I wouldn't dream of telling somebody to be their first investment to be 80% in stocks. They should be 100% in stock. In the first year, maybe they'll put away $1,000. That's a drop in the bucket compared to the value of their career and the value of what the investments will ultimately be. And by the same token, at least at these interest rate levels, I'll comment on that in a second, I wouldn't dream of telling everybody who was 87 why
you say
you're
that
laughing.
with pride. You say that with pride and enthusiasm.
To be 87% in bonds. I am not. I'm approximately 50-50. And so a lot depends on your own requirements. And this rule of thumb, first of all, very important for people to think about, and that is just about everybody that you're going to be talking about, every investor you're talking about, also has Social Security. And that has a capitalized value. What is that? The size of that asset pool you would need to create the returns you get in your monthly Social Security check? Probably $350,000. So if you have $700,000 and $350,000 of Social Security, and you put 100% of your stocks into that, so it's $350 in stocks, $350 in this bond-like investment, and you're 50-50. So take that into account. If you have a pension from a local government or from a corporation that's not going to go bankrupt, I quickly add, you should add that in. What you're trying to do when you retire, which I am going to do someday.
I think you're going to fail at that. I think you're going to fail at that,
Would
Jack.
not be my first failure. But when you want to do that, you want to ensure a monthly flow of income. So don't watch the market. Just make sure your portfolio is producing income and will continue to produce income. So you get your Social Security check every month. You set up your mutual fund account or your index fund account for a monthly payment. You can do that. And just you want those payments to be stable, and with respect to Social Security and the fund alike, will grow a little bit over time. Dividends are an extremely important part of this. And ever since the 30s, which were a terrible time, early 30s and the Great Depression, when dividends probably got cut 75%, there's only been one period of time
Not that long ago. Well, we're almost 7
where
years
dividends
out.
were cut by, I think, about 25%. And that was from 2008 to 2009, when in the financial crisis, the banks had to eliminate their dividends. But it's a line like this, with this one bump in it. So I think you can count on that under any foreseeable circumstances, to which I quickly add, there are a lot of unforeseeable circumstances out there.
But there is a lot of cash on the balance sheets of corporate America to suggest that the dividend is pretty secure.
Yeah, exactly.
for-
Payouts are low. They're probably running, the long-term payout is probably 55, 65% of earnings, and now they're paying maybe 35 to 45% of earnings.
I want to go back to something you mentioned a minute or two ago about the importance of fees and really looking at what you're paying for that return that's being created by corporate America or corporations around the world, and then the fee that is the one interruption for you to actually getting that return. Would you suggest then that somebody who's going through and evaluating a mutual fund to purchase, and there are sites and services like Morningstar and others that have all of the ratings and reviews and they tell you about the manager and all the rest, would you say that the best thing that someone could do would be to remove all of those factors and just rank them by fee and buy the ones that have the lowest fee? If you could do that without looking at anything else, obviously you'd end up with a number of Vanguard funds because your fees are average 0.12%. But is that a better methodology than the average person is using to pick a mutual fund?
Well, I'm tempted to say, and will say, ask Morningstar. They say that their sophisticated rating system works almost as well as simply rating the funds by cost.
Wow.
So they have entered the confessional booth with characteristics.
This has been happening for you over one decade after another. Which next financial provider is going to enter the confessional booth?
Well, the problem with that is this industry is run for the managers. They're the ones that put up the capital to start the management company. There's the ones that sell out to financial conglomerates. And today, we have among the 50 largest mutual fund groups, we have one mutual fund company. That would be Vanguard. We started the company 42 years ago, and Vanguard meant leader in a new trend. And we have failed as a leader. 42 years of success, and we have yet to find our first follower. Think about that. So they're going to have to eventually, money
Is that true? I mean, we were talking before about BlackRock. Isn't every fund company out there putting an index fund out there? Don't you have everyone following you?
Well, BlackRock has been able to do specifically. The ETF exchange-traded fund business is basically BlackRock, Vanguard, and State Street, and then it totally dwindles off. The traditional index fund business, the kind I started back in 1975, underwriting in 1976, is Vanguard has 80% of that market. Fidelity, struggling along, has 10, and 3 or 4 other firms do the remaining 10%. So, and people hide it. For example, T. Rowe Price has some index funds. They're very good, but they charge 0.25% a year plus 0.25% compared to 0.05%. You could say they're overcharging the investor by 20 basis points, and I would say that's a way of looking at it. But what it really says is, if it's all the same to you, give us your active management business and don't buy our index funds, because they make more money at that. This is capitalism at work, as I've said before.
Isn't there a company that maybe is analogous, not perfectly to the zero sum that you outlined for finance, in a company like Costco? When I think of Costco, I think that's the closest thing that I associate with Vanguard in business.
Sure. Well, we use Costco. My wife does.
You pay the flat annual subscription, and then everything else is marked down to.
But they still are a public company that wants to make money, and there's nothing the matter with that. I just try to get this through people's heads. There's nothing the matter with doing that. The problem is, in the financial business, value and cost are the reverse sides of the same coin. When you go into Costco or anything else you can think of, there's a value in your mind. You buy a Mercedes-Benz, you got a lot of value out of driving. Now, I don't know why anybody would get any great pleasure out of that, but maybe it's pride. Maybe they think Mercedes-Benz is a new star somewhere in the sky. I don't know. But you can't directly associate the cost with the value. But in the mutual fund business, it's how the returns are divided up between the marketplace and the investor. So this is a hard business to do it in without giving up your profits. Costco is not going to give up theirs.
That's the power of the mutual structure.
Nor is Target, which is my family name for Target.
A couple principles of investing questions. Warren Buffett at some point has said, It turns out to be true of Motley Fool data as well. Warren Buffett has said that if he had never sold a stock since he was 11 years old, he would be a lot wealthier and Berkshire Hathaway shareholders would be a lot better off. We looked at all of our investment results of the Motley Fool. If we had never recommended a sale, the overall net returns would be better, particularly if you factor in capital gains taxes and the time and energy and emotion of trying to figure out when to sell something and buy something else. Does that align with how you think at Vanguard? Do you think the best thing that somebody could do if they came in at 25 years old for their first Vanguard account in their 401k or in an IRA, if they just bought and said, well, you know, I saw this interview and Jack said I should just never sell that no matter what happens out there in the world, just keep adding money and never sell is a good principle?
Sure, that's right. Now you want to be sure you're on a broad-based index fund, and I would say traditional index fund. You can buy a Vanguard ETF, exchange-traded fund, for the S&P 500. It's part of the same identical portfolio, the 500 portfolio we have here, which is largely owned by traditional index fund holders, and to a smaller extent, maybe 20%, owned by exchange-traded fund. Same product, more or less the same price. And if you hang on to it, it doesn't matter which you do. So you hang on, and I'll give you one little example. The lawyer for the underwriters in our initial underwriting in 1976, one of the greatest flops in the history of Wall Street.
The underwriting or the lawyer?
The lawyer. No, the underwriting, excuse me. Good question. And we had a 40th anniversary lunch the other day, and not too many of them left. They don't seem to be quite as hardy as you know who. And he said he bought 1,000 shares. He wanted this tragic underwriting, tiny.
It was like an $11 million
$11 million
take, and what were the expectations?
What he said was, you know, we were sure we could do 250 million, and then we got a pretty good chance at 200 million. It looks like 150 million is in the bag, and if we reach just a little bit more strongly, we'll get to 100 million, and 50 million ought to be duck soup. And I know we can get 25 million, and the check comes in and it's 11.3, and so he felt badly about it. He'd made a nice fee, I guess, from it. And so he bought 1,000 shares at $15, put in 15,000. And he brought his statement to the meeting.
That's great.
He's held it ever since. And he has paid any taxes out of his own pocket, income taxes. And at the outset, we had a few more capital gains taxes, but not very many. And I don't think we paid a capital gain distribution because we don't sell anything for probably 20 years now, something like that. And I'll ask you, $15,000 in 1976. What does he have today?
Okay. I'm going to say that he has $15,000.
I know you're supposed to be asking the questions.
I'll say he has 106,000.
Wow, what a great guess.
I'm way off. Darn it. No, of course I'm way off. I'm not even close. No, excuse me.
$903,000.
Yes. Yeah.
$903,000.
Yeah. We're going to edit that out.
Edit your part out. Keep
I'm going
my
to
part
say
in.
900, give or take 3. Yeah, that's
Brilliant. It's the best guess I've ever heard.
Well, I remember reading about Shelby Davis. I don't know whether you knew Shelby Davis Sr. or
He was big giver to Princeton University.
Okay, yes, okay, your alma mater.
Insurance stocks.
And yes, he had started with 50,000, and he came up with the principle: I should never sell, because the worst thing you can do is lose a huge winner.
Yep.
Saving yourself from losses is minus 100 at worst, and that's rare. But if you miss the huge, great long-term winners, and he turned $50,000, and he did 24% a year. Of course, he used margin, but he died with $900 million from that 45 years later. So,
well, I feel really sorry for him. You know, think about it. It could have been $1 billion.
Exactly. Got so close. What about risk? How do you assess risk? If we're now saying, oh, put your money in, let it ride, add to it over time, start with 15,000, you find yourself 40 years later, you're going to have $900,000 or something approximating that, depending on how the overall market does in the next 40 years. But what about larger risks? What risk could reasonably threaten that in the next 40 years? Or are you telling your grandchildren in their 20s now, just go with this game plan?
Well, I do for my grandchildren. They can change it when they get there. They don't really know how much money I put away for them over all these years. And I've always put it in balanced index fund. 60% S&P 500, or total stock market, I should say, and 60% total bond market.
60 and 40. You said last time we talked that anyone watching could put all of their money into that one fund and make it their sole investment
Sure.
throughout life.
Now, it's conservative and it protects you against your emotions, because when the market goes way down, stock market goes way down, the bond market actually usually goes up a little bit under that circumstance. So investors have behavioral problems, and they panic if their account goes down 50%. An account like this probably goes down 32 or 3%. So you don't get exposed to the worst of it. There's no question that a 100% stock portfolio will do better in the long run. I mean, that's just the numbers. As stocks will return over the long run, not every 25-year period, but probably 3 out of 4, stocks will return more than bonds. They will be the highest returning investment because they have a higher risk. Now, what is risk? Let me tell you what it is not. It is not volatility. We use volatility to measure risk. You know, if the market goes up, let me say, or down 25%, and you own the market, that's what you do. If you want to reduce the volatility in a balanced fund, you know, you maybe go up or down 15%. And if you want to get an extremely aggressive fund, maybe up and down 40%. But it's symmetrical and fairly symmetrical. And so that's a way of measuring, but it's a short-term thing. In the long term, the risk is that you may lose one hell of a lot of money. If you started buying stocks in 1919 or 1920 or 1918, you were doing fine through 1929, and then you lost 90% of your money in an all-stock portfolio.
And it took you another 15 years to get back to even or something.
Yeah, actually a little more, just about right, 15 years in mid-40s. And so those kind of risks are big risks. And the risks that we can't measure, there are risks that come from things like, what is the probability that our society will collapse? What is the probability that with all the undercurrents that are going on in American society between the haves and have-nots, and the haves, the superior, larger races and the minorities, those gaps are very wide, and I'm deeply concerned that we may get in some real trouble, and that's why I describe myself as so conservative that I'm liberal. I want to protect our society, and therefore I want to protect those segments of society that haven't been treated fairly to the best of our ability. And then there are the known risks, like nuclear war, worldwide disease, plague kind of thing, religious uprisings, the things that we know about and worry about today. And then, as my fellow Princetonian Secretary of Defense Donald Rumsfeld says, those are the known unknowns. And what about the unknown unknowns? And of course, since they're unknown, we can't comment on that, about that.
But none of those unknown unknowns, or none of those big risks, cause you to change your investment approach, I guess, because the assumption is if the market goes down 90% on the Bogle family portfolios, that there are so many other problems in the world, it's probably not going to be a make or break thing for you that your stock portfolio is down.
Well, no, as a wise man once said, if there's nuclear war, it won't matter a hell of a lot whether you own stocks or bonds. It's gone. Society is gone. It's frightening to think about. And I think that given the enormity of these kind of risks that I've described, and the unknown risks that we really don't know, we don't know what they are, which is kind of frightening. But invest you must. As I've said to people, probably on television or interviews kind of thing, the one way to assure that the value of your retirement plan is zero is to not invest a penny, and zero is guaranteed. So you have to put your money to work. In the extreme circumstance, even cash is not going to help you. It's not going to be any good if the nuclear bombs start going off. It's a frightening, fragile world that we live in. So you can sit and worry about it every day, and in certain respects, if you like to worry, it's a good thing to worry about. But you kind of have to get on with your game, prepare for the future, and hope that those extreme risks don't come home to roost.
I want to give you 3 one-liners that I've heard from investors in the last 6 months, 6 years since we started The Motley Fool. Throughout life, you'll hear lines like this, and I'd like your quick reaction to each of them. Stock market is just a big gambling machine, and it's probably rigged too, so I don't invest.
In the short term, the stock market is a casino. That's correct. In the long run, it is not a casino. It's a machine for compounding interest and returns, which, as Einstein said, is the greatest miracle in financial history.
I tried to convince Daniel Kahneman, the Nobel Prize winner, that the market is more predictable in the long term, and he wasn't really buying it or having it.
Well, you know, it all that, like everything else, it all depends. The idea that what is totally unpredictable in the short run is more predictable in the long run is a little insane when you think about it. But there are internal dynamics to the market that will prevail as long as the nature of our society prevails. And that is corporations serving consumers, serving corporations, serving government will make money. And if they innovate, if they become more efficient, if they have a lot of entrepreneurship on their side, if they're technologically well qualified, even leaders, they will do fine. But there's always that big if that hangs over it. And any investor that disregards that big if is making a big mistake. You know, I think about it, but do I crawl into a hole and take my money with me, such as it may be? I'd be more worried about someone digging up the grave and taking it away from me while I'm lying down there.
Next one is, when it comes to investing, I just give my money to my friend Frank over at Name Your Big Wall Street Bank. I don't really know what they're doing, but such a friendly person. I'm sure that they're taking care of my finances for me. I mean, a huge number of people don't want to deal with this subject. It's like dentistry for them. And if they can outsource dentistry, they're going to be very happy to do so, and they turn to their college friend or friend of a friend who happens to work at a big firm and has been trained to be very friendly with them, and they're just going to hand their money and say, please don't lose it, Frank, and I trust you.
Look at the numbers. How is Frank doing for you? How has he done for his other clients? Why is he trading all the time? Because that's good for him and not good for you. So you should basically, this is not a personal matter about finding a friend. As they say in Washington, you know this, Tom, if you want a friend in Washington, get a dog. And you wouldn't do this with your dog, and I don't think you should do it with your friend either. These are honest people by and large. They don't really realize that the more they trade, more they have you trade, the less well you do. So activity is essentially the curse of Wall Street. If there's no activity in Wall Street, there is no money in Wall Street. Every day, all those $30 trillion of stock that's changes hands, something like that. One person's buying, one person's selling. It creates no value. It shifts value from A to B or from B to A, and the system of Wall Street takes its cut out of the middle. So the gambling, the casino comes up again. You know, the croupiers of Wall Street, like the croupiers of Vegas, as it's called, I believe it's Las Vegas, he said, and you know, all the bettors that bet red and all the bettors that bet black are equal, but they don't divide up the returns because there is the croupier, and he's got this rake, and he pulls his share off the table. So, love Frank. Buy him a drink every once in a while. Encourage him to tell you the latest jokes, which he would probably do if he was the broker. But think about investing as a long-term thing that doesn't involve any trading whatsoever.
I wanted to talk a little bit about leadership. You started Vanguard and have been here at this organization for decades. As an investor, looking out at the world, I observe, and I think there is data to show that companies that are run by their founder in the public markets end up doing better than the market's average better than market's average return. You have Howard Schultz at Starbucks, you have Gates at Microsoft all those years, Buffett at Berkshire. So what do you think, why have you remained with Vanguard all of these years? I mean, you set it up, the system that you created is running and scaling probably, I don't know if it's to greater dimension than you ever expected or not.
Of course it is.
So what is it that's driving you at 87? My grandfather went to work every day until he was 94. And what's causing you to come to work every day?
Well, I love helping the shareholders. I really do. I hear from them literally every day, to the point where if I haven't gotten a nice shareholder letter by noon, I will say, Emily, do you think you could check the inbox? And they keep you going, and our crew here keeps me going. I spend a lot of time with them. I spend an hour with each, just one-on-one with each Award for Excellence winner. I did probably 3 anniversaries last week. I go and celebrate with the 35th anniversary, for example. Happened to be a woman. And so they have all the staff there, so I get to talk to a whole bunch of people and try and ensure that this legacy of the kind of firm that we want to have, based on those Quaker values, service, efficiency, economy, patience. Well, not so much patience. Patience there, not for me. And so it's carrying on the mission with your child. And you know, you can run the company or not running as you are, but you're still the father of the firm. You're still the founder of the firm, as you mentioned. And so you keep that spirit alive and try and use what is left of you to, a lot of what is left of your life might be a little happier formulation, to help the people you've been helping all these years. And, you know, I'm not starving to death. I mean, I haven't built up a nice little amount of capital. It'd be embarrassment to tell you what it was. We have enough, to coin the phrase of the name of one of my books. And we don't need any more things. And my wife is not a spendthrift at all. We're agonizing about, we have a fairly large charitable budget, and agonizing about where it all goes right now. And so we kind of choose up, give a lot of money away, and a lot for me. And we love doing that too. So it's been good in every way. And you know, a name and reputation is something you can't quite take with you, but you certainly can't take the do-re-mi with you, Tom. As my brother-in-law, who died before I did, he was a year or so younger, said, if you can't, he made a lot of money in this business by selling their company a couple of times, investment advisory company. He said, if you can't take it with you, I'm not going. But he went anyway.
Mm-hmm. What do you think of succession here? You know, I know that there's, over the next 50 years, maybe there's an effort to demutualize the company or the mutual. I think of Albert Barnes, the Barnes Museum in the state of Pennsylvania, and you wouldn't have thought that his trust could be penetrated, but it was. So how do you set things up and with the greatest chance of playing out your vision?
Well, I think it actually speaks for itself. The shareholders know how well they've been served. They increasingly understand what we mean by a mutual company. They certainly know what we mean by low cost. And if you were going to demutualize, you'd have to pay them something. And it would be complex. It would be contra to the system. And for all our concerns about protecting it, there's never been any more successful company in this business than we have been in terms of total money generated. The only difference is that it's generated for our mutual fund shareholders and not public shareholders or financial conglomerates that own mutual fund management or anything of the like. So the money's going in the right place. It's right there where Adam Smith was. The principal role of the manager is to serve the shareholder. We all know that. And it's a great business strategy. You know, it's frightening to think $1 billion a day. Think about that, coming in here. We used to have a party every $1 billion at the beginning, and I'd make a speech. Mm-hmm. I don't know that I could really make...
You'd be partying every day.
Well, yeah, 240, because I'm counting business days. Mm-hmm. I might as well be clear on this. Mm-hmm. And, you know, my voice is a little... Can't really do that probably every day, although I'd give it a try. But I think the perpetuation of this system, it has been so successful that it would be almost inconceivable for anybody to recommend that it be changed, and inconceivable for the shareholders to vote in favor of it. You know, we can't just arbitrarily do it. These shareholders are in fact our owners. So I think it is not